We've selected a few MCQ format questions, and Rob would be solving those questions now with us and also giving us a commentary on how he thinks.
Have my calculator here.
He's brought in his
HB12C.
HB12C calculator here, which honestly I've seen for the first time, being 15 years in this ecosystem.
Okay, so Sue Young, CFA, is an analyst at a large investment firm. After thorough research, she issues a sell rating on a company, submits her report to her firm's investment committee. The committee disagrees with Young's assumptions in, I guess, the sell rating report. And so they change it to a neutral rate. So they change her sell to a neutral rating. Interesting. The final report is issued and Young agrees to leave her name on the report. So wow, so she had a sell. Now it's the committee, not her, change it to neutral. Has she violated these standards? Well, let's think about this. So what standard is at issue here? It's going to be it's going to be reasonable basis, I think. Loyalty, prudence, care is actually unrelated, as you'll see when you go through that part of the ethics of code and standards, duty to employer and so on. So that you would pick up, by the way, by just simply knowing about the different areas of code and standards. So, okay, so it's about diligence, reasonable basis. Well, it says thorough research here. Let's just pick that out here real quick. It says after thorough research, here we go, pen. So I think that means that she was diligent.
Yeah.
It was the committee that changed her recommendation. They disagreed with her, but it was a committee. So I'm going to assume committee was also diligent and had reasonable basis, because there's peer review that was taken on a committee there. And so the rule says that you need to have a reasonable basis. And also actually thinking about the curriculum itself, there are questions in there which talk about this issue. Actually, there are some questions quite similar to this in the CFA program.
The main question here is, can she still leave her name in the report?
Right.
Because now the rating has changed from what she originally thought rating was.
And I would have thought the answer is yes, because there is a reasonable basis linked that comes from her committee.
Yes.
So therefore, she's not violated. So I'm actually going to say she's not violated standards. By the way, I think she is entitled, based on my reading the curriculum, you can remove your name from reports. You're entitled to do that.
Yeah.
She left it on, which is fine because there's reasonable basis. She just tends to disagree with it, her opinion. But that's opinion. But because there was diligence involved, because the committee had a reasonable basis, the answer's no. I think the answer is no. She's not violated.
Yeah, that's correct.
There we go. I'm trying to circle that. No. Is that correct?
Yeah, spot on 10.
Great. Wow.
Yeah, and I think same logic, right? It's okay to disagree as long as you have a reasonable basis as a part of the group. Is my understanding correct? And that's the thought process here?
Yes, there needs to be. The report going to the public or investors has to have a reasonable basis. This looks like it did have a reasonable basis because the committee reviewed it, and they wouldn't have changed it on an unreasonable basis. They would have applied diligence to it and professionalism. So I think she's on safe ground.
Okay. All right. Let's move on to the next one.
An analyst gathers the following info about a company: ROE, which is presumed return on, it's going to be return on equity, 10%. Leverage 2.0, net profit margin 4%, EBIT margin, operating margin 5%, and interest burden 85%. And the question looks like the total asset turnover ratio is closest to what? Okay, so this is a pretty classic area of the CFA program curriculum, and it's called, if my memory serves me correctly, DuPont disaggregation of returns. And so what DuPont tells you is that to get to return on equity, you take the asset turnover, asset turn as it's called on Wall Street, you multiply by leverage, because you can lever those returns up, and then you multiply by the net margin. In short, call the net margin on Wall Street, and that will give you let's go back here, sorry. That will give us the return on equity, essentially. Meaning, so if you're getting more revenue out of your assets here, you get higher ROE. If you leverage will juice up ROE, and so will net margins. They sort of multiply together. So what do we have here? We don't know the asset turn here. That's unknown. Leverage is 2. Net margin is 4%.
Yeah.
So 2 multiplied by
ROA is 10%.
ROE is 10%. So 10%, that's right. ROE is 10%. Yep. 10% is just a missing algebra.
Yeah.
10% is, so I do 2 multiplied by 4 is 8%. 8% by what is 10%? So that's going to be 1.25. So, oh, wait a minute. That's not an answer choice.
Yeah, I think the 1.3 is just being rounded off here.
It's closest to, which makes me feel more confident I've not made an error. So I'm going to go for 1.3 or answer B.
All right, there you go. Fantastic.
Is that correct?
Yes, absolutely.
Very good.
One of the reasons why I thought this question would be very interesting is because the question has some information that is not really used to answer the question.
Mm-hmm.
Right? For example, you have information on EBIT margin, and you also have interest burden, which is a part of expanded DuPont, but not useful in this particular situation. So,
right, exactly. So
these are things candidates learn, I think, when you practice enough questions.
Yeah. So you had to basically know that is simple mathematics.
Absolutely. All right. Thank you for that. Let's move to the next question.
Moving on. See what is coming next. I'm scared. Okay, what is this?
Which one is that?
An analyst gathers the following info about a hedge fund.
Yeah.
So it looks like a fee calculation.
Fee calculation.
200 mil AUM at the beginning of the year, 2% management fee based on year-end assets and AUM, 20% incentive calculating net of management fees, gross turn 25% during the year. Total fees. So the question is, what's the total fees? Okay, so there's basically, I think, 2 types of fees here. We've got the management fee, and then we've got the we've got the incentive.
Is that the 1.5% question? Management fee is what?
It says 2%.
Okay,
right. So how do we go? So let's calculate this. So we start with $200 million, and then we're told that the gross return is 25%. So if multiply by 1.25, like so, we realize that we're going to get to $250 million.
Yep.
And it's like, all right. And then we go, the management fees based on year-end assets, well, that's 250. And then, so the 2% management fee
on 250.
2% multiplied by 250 equals, what is that? $5 million. That's right. Yep. Thanks for that. Yes. So it equals the management fee.
Yeah.
So what have we got left at that point? So then we have, if we take off 5 million, we've now made 45 million on the 200. So we've got $45 million of returns on which to calculate the incentive, which is 20%. So 20% of 45 million is 9 million?
Right.
So there we go. So we got basically equals incentive fee. So the answer is 14. So I think B. Is that right?
Yeah, absolutely. Can you please explain the 45 bit of it?
Sure. Yes. Right. Yes. So the 45%.
45 million.
I beg your pardon. I beg your pardon. Yes. Right. So the way I got 45 million from was we went from 200 million at the start here, and then because we went up by 25%, we got to 250 million. And so the delta, the actual amount we made was 250 minus 200 equals 50 million.
Right.
Like that. And then basically we then took off the $5 million management fee.
Right.
And so we got to 45, which is the amount we had to play with our incentive fee.
Yeah. And you did that because...
Sorry.
So I need to deduct the management fee when I do the incentive.
Exactly.
Yeah.
Yeah, the beauty of these for me is when you go through the curriculum, there are lots of questions like this in the curriculum, which gives you a hint. It's like, well, maybe there's a question on that in the exam itself. Maybe there is. Who knows? But also, what I love about it is you actually once you understand the principles at play, you can almost think about the the actual question from first principles without actually studying much. Once you understand the principles, it's just basic mechanics.
Yeah.
You're like, okay, I can take any question. I just need to understand the mechanics.
It's the basic, yeah.
And then you don't actually need to have. There's not much to know to answer them. It's just applied common sense.
Yeah.
I would say. Yeah.
Right.
Next one.
Next one.
Do you have another one for me? Let's have a look what you have. Ah, wow. Looks like another one.
Another fees one. Yeah.
So in this case, an analyst gathers the following info. Beginning AUM 200 million. Okay, that's the starting point. End of year, just like the last question, 1.5%. Okay. Then we have an incentive of 20%. Ooh, hard hurdle rate 5%. Okay, so that we haven't seen that on the last question.
Yeah.
Hard hurdle rate.
We've heard it, yeah.
Which means, by the way, I'm just thinking out loud, basically you have to get up to 5% minimum before you can charge your incentive fee over and above that hurdle rate. And then the over and above, if I do, then great, I can charge 15% of the over and above there. Okay. It's based on returns net of management, so it's just like the last question. So let's apply the mechanics. So total fee, it's the same question. Okay, same question. All right, great. So I'm going to take the 200 million, it looks like euros. I'm going to take the 200 million. I'm going to, where's my actual, beginning of the year is 200%. Annual return, yes, 15%, right. So I'm going to multiply 1.15. How many euros at the end of the year? So I've got, what, 230 million euros?
Yep.
Okay. Which means I have a surplus has been 30 million euros, which is what we're playing with here.
Yeah.
So let's first of all remove the, let me see, 1.5% is the management fee, but of the total. So I'm going to take, all right, 230 million multiplied by 1.5%. So 1% of 230 million is what, 2.3. So 1.5% is going to be what? Your math is better than mine. I'm going to trust you. Okay, you think 3.45 million?
Yeah.
I trust you.
Yeah, I'm not sure. I think so.
I could use my HP tool.
Yeah, sure. Let's
use it.
Yeah, is that right?
And it does 3.45 on the Hewlett-Packard 12C calculator. There we go.
Fantastic.
So okay, so the surplus has been eaten into now by the management fees. So how much we got left now?
So
30 mil minus 3.45. We can probably do this on our heads. Is 26.55?
Yeah, and then I think we have hurdle as well.
Now we have a hurdle rate of 5%. So what's 5% of 200 million? This is quite easy.
10.
5% multiplied by 200 million is
10.
10 is 10 million. Yes, that's correct. Great. So what are we playing with? We're playing with 26.55 minus 10 is the amount we can charge the incentive on.
Right.
So 26.5 minus 10, that's easy, is 16.55. And then the actual incentive fee is 20%.
20%.
Great. So I'm going to take 20% of that. Thank you very much. 0.2. So 0.1 of that is 0.1655. So 0.16, let's do the math here. 3.31?
3.31. Okay.
So the two power numbers here, this is the MGMT, and this is the incentive fee. And so 3.45, we do this in our head, 3.45, 3.31 is what? 6.76. Is that right?
Yeah.
6.76, so what, 6.8?
6.8. There you go.
Is that correct?
Yeah, absolutely. All right, now we have a couple of questions left. They're on derivatives. Very interesting ones. You're going to enjoy them. Let's go to the next one.
Next one, okay.
These one are actually picked up from the CFA curriculum. I think LM2 or LM3.
Yep.
Let's see if you can do these ones.
So Biomian is a Mumbai-based biotech, common stock with futures and options on NSE. First one family office owns 10,000 Biomian common shares. Lots of numbers here, or rather, the first number. The family office wants to reduce its Biomian position, diversify its exposure, but would delay a cash sale of shares for tax reasons for 6 months. Okay, so they want to get out, but they don't want to sell. Yep. Interesting. So which of the following derivative contracts is best suited to reduce exposure to decline in Biomian stock in the next 6 months? And then it talks about short call expires in 6 months, long call expires in 6 months, short future position that settles in 6 months. Well, let me think about this. So, well, you've got three instruments here. You've got a put, a call, and futures. Well, first of all, if we want to reduce exposure, a long call won't do it, because in a long call, you have a kind of payoff diagram like that. But actually, what we're trying to do is we're worried about it going down. So if it goes down, that's going to lose us money. So that's not very useful. So I'm actually going to strike that. I would do right click in the exam, right click strikeout. So that is actually not appropriate. And then I'd say what a short put. So a put typically is sort of this payoff diagram. That's what the put is, but it's a short put. So we have the inverse of it, right? So we sort of have that like that. So that's not going to be very helpful, because it loses money again when it goes down. So I can now actually answer the question without looking at answer C.
Yeah,
if I love risk,
absolutely.
I say, you know what? I don't think it's that. Just cannot be that. Answer C.
Yep.
But let's have a look at C, just because we're risk averse, meaning in the exam. A short futures position in environment stock. Short futures. Yeah. So we're making a commitment to basically benefit from a decline with an agreement in 6 months, which matches. I think what they want to do. They want to delay that. I think that's perfect.
Protect the downside.
So actually, I'm now even more confident it's C.
Absolutely.
Yeah.
10 on 10, spot on.
Yeah.
Yeah, and I think the quick, like a teacher's trick to this when we solve this, you have one long call. Sorry. Yeah, there's long call and short put, right?
Yeah.
So we basically kind of, in the class, we kind of know long call, short call, long put, short put.
Yeah.
Bullish, bearish, bullish.
Mm-hmm.
So the first two options are actually bullish.
Right.
And the third one is a bearish.
Yeah.
So someone who's in a hurry and don't want to spend time, just, select C and move on. Because anyways, it cannot be between A and B, because both the positions are bullish that way.
Exactly.
All right, let's do the last question now.
Okay.
This is an interesting one. It's on options.
Okay, so let's have a look. So the family office market strategist considering 6-month call option strategy on Nifty 50. Okay, so they want to leverage their returns basically to increase. Yeah, you're going to get leveraged returns on the upside. So Nifty 50 today is 15,200. Okay. They observe the call option with a 16 exercise price. So a 16 strike exercise price means strike. Trading premium, that means you're going to have to pay 1,500 rupees today for that instrument. Okay. So which of the following represents a payoff and profit just prior to maturity if Nifty 50 is trading at 16,500? Okay, so the first thing I'm going to say is, well, wait a minute. Let's compare these two numbers. And I'm like, okay, so is it going to make money or lose money in terms of at the payoff date? Well, 16,500 over 50 is above 15,200, which is good because I bought a call.
Yeah.
But actually, I need to compare it to the strike price for the day. And actually, yes, there's 500 profit to be made because I can now buy something worth 16,500 for 16,000. So I'm going to make 500 there. 16,500 minus 16,000. I'm going to make profit. Pi profit equals 500. But I spent, for the privilege of this, I paid up front 1,500. So that's actually, the cost was basically this. So my actual net on the scenario was actually, so I lost money. So what are the options? Payoff is blah, profit is blah. Well, I know it's the correct. I don't need to look at the other ones.
Yeah.
But let's do it anyway for fun. So yeah, the payoff is 500. So the payoff, this is, you can also call this the payoff. There are many things to call things in finance. But yes, payoff is that. And then they call that profit. Okay, sure, profit. The next one, payoff is 1,300. Wow. So that's actually completely wrong. In terms of the difference in 16,500, that's definitely wrong for that reason, and the profit's different as well. And the next one, it's just completely off the mark.
Yeah.
So actually, this was interesting as well. Looking at this question, what's interesting as well is the fact that the first one actually is the only one with a negative.
Yeah.
Which is actually another way, I guess, a shortcut you could do in the exam. Say, well, actually, It loses money, and only one option loses money. There'll be another way to answer the question.
So you can quickly get it.
Yeah, if you were wanting to take a risk.
This is an interesting one because I think classic level 1 question, because you have a positive payoff, but you have a negative profit in this situation because you overpaid the premium.
Right, overpaid the premium, exactly. Cool.
All right, that's very interesting. Rob, thank you very much for doing this. I hope the audience enjoyed doing this brief session with us.